All right. Hello, everyone. This is our next section and our first presentation on investing. And we'll go ahead and get started. Couple of notes before we get started, and to give you a little bit of the method behind my mayhem. In the academic world, we call that pedagogy. This next section and how I'm teaching it has a very specific purpose. What I'm attempting to do is teach something in a manner that hopefully you'll get financial literacy out of it. And afterwards, you'll better be able to read financial books, articles, and some of that, and hopefully it'll make sense. The other purpose is that you learn how other people manage your money. For example, 401ks and 403bs. Usually you have an opportunity to select from 20 different mutual funds, and they'll have different titles such as value fund or income fund. So hopefully after this exercise, you'll better be able to understand how it is those mutual funds are created and what purpose they serve to create them in that manner. Now, the reason I say that is we're actually going to go through and do what's called a stock valuation, and very much what a mutual fund manager would do when trying to select the different stocks to create a mutual fund. It's not necessarily intended to be a framework for you to invest money. And I always have students ask, well, Bruce, could you use this to invest and, sort of theoretically make money off it? And the answer is yes. There's no rule, and there's nobody's out there. There's no investing police that say you have to use this method to invest money. That doesn't exist. So knowing that, this is just sort of what the professionals do to manage money, and it's a truncated form. Okay, so we're not going through the entire process and stuff like that. We're just doing a brief version of that so you can, again, better understand how others manage money. We're going to start off with first just having a little introduction to investing and finance so we have some better concepts in our mind. And the first is I often get students that have taken a corporate finance class, or they've taken maybe an investing class or something like that, and they always get confused because in one area we use the same information, all the analysis is the same, but we look at it very differently. And it's very much like looking at different sides of the same coin. And when you're looking at different sides of the same coin, what you're looking for, the perspective that you're looking at it, is from either the agent or the principal. Now, the principal is the owner. They are the owner of usually stock or owners of a company. And those owners hire agents to run the company. So here we have Warren Buffett is sort of the owner, the investor, and on the other side, Marissa Mayer, the CEO of Yahoo, would be the agent and the person hired to, again, run the company and the operations of that company. So when you hear me talk about principal, know that I'm talking about the owner or investor. And when I say agent, I want you to think of the CEO. Now, Warren Buffett does not own Yahoo, but these were well-known CEOs and principals. So anyway, anytime you have the principal and the agent, okay, you have in the owner and operator are separate. They're different people. At that point in time, you have potential for what's called the principal and agency dilemma. Okay, and that's when the person running the company is doing things differently than the way in which the principal wants it ran or wants it operated. So again, that's called the principal and agency dilemma. And sometimes when that happens, you have what's created is called a moral hazard. And that is when the incentives aren't aligned properly and the agent takes unusual risk in an attempt to earn a profit when the owner of the company would not have wanted that otherwise. So again, that's called a moral hazard. Now we'll get into a little bit of a quick review of finance. When a company starts and it's trying to get things operating and moving, it has to have money to do so. And a company has two essential sources of starting or financing this. One is through debt. And debt is, we have two forms of that. We have a company can get money from bondholders, or a company can get money from banks. If they get it directly from bondholders, that's called direct finance or direct debt. When they get it from a bank, that's called indirect debt, because the bank acts as a financial intermediary between the depositors and the company that it's loaning out money to. So that's why it's called indirect. And then on the other side of things, if a company didn't want to use debt, or might as well, they'll use what's called equity. And equity is usually known as common stock or preferred stock. And with common stock, you have voting rights. So those principals that buy common stock can vote on certain overarching policies of the company. They don't usually vote on day-to-day operations of the company. They wouldn't do that. And then they have preferred stock, which is similar to common stock, except usually the dividends are higher and better. And in preferred stock, the stockholder, the principal, has no voting rights. They also have first dibs on dividends before common stockholders ever receive dividends. So again, a company has two ways of financing something. One is debt and the other is equity. And you always have equity in the firm, but you don't always have debt. And that gets us into some terms. Normally I have students break up into teams to go through these different terms. I'm just going to read them off. And we're on, if you go to D2L and open up, let me see if I can find this here, your guidebook. I believe we are on page 64 is where I'm at. And I'll just go through these. We're going to look at these financial terms to know. So we can blow this up a little. So you're familiar with these terms, because after this I'm going to start using these terms as if you do know them. So the first definition is stock, and stock is a form of equity. We have common stock and preferred. And when a business incorporates, the equity is split into equal shares among those investors that have a stake in the business. The investors usually split their shares of business into logical and equal parts so that portions can be more easily sold. Then we have those shares of stock. So once the business incorporates, the portion of each investor receives is called shares, or that apportionment. Then we have a previous close. And what all these definitions here work with or are in conjunction with is what you will be seeing on a Yahoo Finance quote screen. Okay, so all of these are just listed right down, so you're familiar with them. Previous close. The previous close refers to the last stock transaction that transpired the previous day on the stock exchange. Market cap or market capitalization. If you multiply the market value of the shares of stock by the number of outstanding shares, then you've calculated the market capitalization of the business. So really what we're talking about there is if you take all the shareholders that are out there, so maybe there's 1 million shares, or yeah, we'll use a nice round number, 1 million shares of stock, and you multiply that by the current price, you basically get the size of the company, or how much it could be totally bought for if somebody had the money to buy the entire company and buy all those shares. So that's kind of what the company's worth, or its market value. Then you have shares outstanding, and this is the number of shares that the investor possesses, or investors possess, that the company does not possess. In other words, companies, when they sort of buy back some of their own shares, that's called treasury stock, and they keep those, and oftentimes later on they'll sell them again to get some more money in, and it helps to manipulate the stock price, and so that's how companies try to control that. Which, yeah, gets us to treasury stock. Treasury stock's the shares that the business or firm has reported from investors. When the treasury stock and shares outstanding are added together, it equals the total number of common stock shares in which the firm holds. Then we have earnings per share, which is a very important definition. We'll talk about how earnings are derived in this class, but a person can really just think of this as the amount of cash earned Okay, so this is just the cash earnings, the cash the company kind of gets to keep right now after it's operated, it had a profit, and we're just going to think about it as the cash the company gets to either keep, or it can send it out and give some of it to the investors in the form of what's called a dividend. So they pay some of that out on occasion. And this number, earnings per share, is that total profit divided by the number of outstanding shares. Okay, so if you saw a stock trading on the stock exchange that was $50, you might see earnings per share as $2. Okay, and again, that was usually last year's profit divided by the number of shares outstanding. Bid or bid price. Stocks traded on open exchanges are traded on what's called an auction. This means that the bid price is the buyer's price point that they would like to purchase the stock at. So you put out a bid. If you think of like a regular auction and somebody's raising their hands to bid a price, that's what this is in the stock exchange. Now the ask price is the seller's price point at which they would like to sell the stock for. So if you're going out and selling it, this is sort of that initial dollar amount that's being asked. The next term you're going to want to be familiar with is what's called an IPO, or initial public offering. When a firm decides that they need more money to expand operations, they take part in what's called an initial public offering. On occasion, the average investor can take part in these types of transactions. However, most stock purchases are conducted on a secondary market. What this means is when a company first goes out to get some more money to maybe expand their operations, they'll put out what's called an initial public offering. So they'll sell shares and then they'll get money in, okay, an influx of money by selling these shares. Now, the thing to note about that initial public offering is once that's done and the company sold all its shares, they've gotten an influx of cash, that's it after that for money coming into the company from purchases of those stocks. After that, any other exchange of buying and selling stock shares afterwards is done on what's called a secondary market. The New York Stock Exchange is a secondary market. That means if I buy 100 shares of Apple on the New York Stock Exchange, Apple doesn't get any of that money. I buy those shares from another investor. So all those investors are buying and selling their shares from each other. No money is going back to the company. It's just between the investors. So again, that's called the secondary market. In the secondary market, where most stock transactions occur, is where stocks already been offered in the initial public offering and can now be traded with other investors. This is important to understand because most novice investors get confused when using metrics and trying to apply them to stock analysis. The analysis we're going to talk about in this class is better applied to secondary market analysis. So that's what we're going to get into. And the last one is dividend yield. Now, a corporation has an option to pay out those earnings or earnings per share in the form of what's called a dividend. Often in mature businesses that don't necessarily have unexplored growth potential in products to consumers may pay out some of those earnings to the stockholder. Okay. Later on, we'll talk about how those are called income stocks. So please review those definitions again on page 65 of the guidebook so you are very familiar with them if you've not don't otherwise understand those, because now I assume you do understand them. And that gets us into this introduction to investing. Now, the purpose of investing is, or the goal of investing is to always create more later on with what you have now. Earlier in the semester, earlier in the section, we talked about using a college degree as an investment. And we did a little bit of math to figure out that the price that we pay for tuition would be called the price, or initial outlay, or initial investment. The additional earnings we receive for having that college degree is the difference between what we could have earned with a college degree versus what we could have earned without a college degree. So we kind of figured out what the additional earnings were. Sometimes that's called incremental cash flow. In here, I'm just going to call it earnings. Okay. Now, one of the things to know about this and what we'll talk about is herd mentalities. See, investors know and are very aware, good investors, of what a herd mentality is. And a herd mentality is chasing after something simply because everybody else is doing it. It looks like the hot buy. Unfortunately, in certain situations, college degrees, and some people have said that's a herd mentality where a high school student graduating from high school may go on to college just because all their friends and everybody else is going to college. So again, good investors know that you don't just go in and buy stock because everybody else is buying it. And good investors, mutual fund managers, good money managers, instead don't follow the herd. They do something what's called fundamental analysis, and that's what I'm going to teach you in this section. So we need to go back, do a little review here, and understand price and earnings again. Price is the initial investment that you pay for something, and earnings is what you earn in the future based on, hopefully, the price you pay. So again, comparing that to a college degree, the price, initial outlay or investments, the tuition, what we earn with it in the future is that additional earnings we receive. Now, when we go through this, if any of you have taken accounting, I don't want, if I say the cash flows of something or price and earnings, I don't want you to think sort of statements and statements of cash flows and things like that. We just need to understand this conceptually. And that means a Wall Street banker, Main Street plumber can apply this information in a similar manner when we're talking about it conceptually. Now, one of the things that in understanding price and earnings, we need to understand some stuff. And I'm going to use the college degree as a pretty good example. And the additional money we earn is how investors perceive this world. And this starts off with a concept of asking, are you in control of how much you earn? And the answer to that is, no, you're not in control of how much you earn. The market is in control of that and always is in control of that. Now, what I mean by that is if we apply this to a college degree and you get a degree in engineering, are you in control of how much you earn in the future? And unfortunately, a lot of students and people think, well, yes, you are, because you went to school for longer or a harder degree or education, and that's why you get paid more. The reality is, no, that's not why you get paid more. It's typically because of supply and demand. It's because of economics. There's fewer engineers than what's demanded. Therefore, the price what they earn and what they're paid in the labor market is much more. So it's not tied. We have to remember that the stuff like that's not tied to education. It's not tied to those things. And earnings that a company earns is the same way. Their earnings are tied to the demand that's in the marketplace. Okay, so the higher the demand, usually and the supply of that demand is the same. Okay, usually the higher the price. We can see that with, I get a lot of times I ask that question and people will try to equate it to, why does a physician make so much money? And they'll say, well, they went to school for so long and all these things, and they'll talk about education. Well, we have to remember, though, that's not why physicians get paid so much. They get paid so much because there's a limited supply and a high demand. And that's why a PhD, a college professor, there's more PhDs relative to what's demanded than in the world of physicians or physicians and medical providers. That's why PhDs get paid less, or college professors get paid less than physicians. There's more supply. So the reason that's important is because we have to understand then that for the most part, those additional earnings or those earnings are static. They're forecastable and they're foreseeable. We know next year how much physicians will earn because we can forecast it. Now, the reason that becomes important is if we can forecast those earnings, then we can determine a price that should be paid for those earnings, at least in the world of stocks and bonds. We can figure out the price because the earnings are static, They're forecastable and foreseeable. This is similar when you look at any job. My wife, who is an engineer, works at 3M. I know approximately how much she's going to get paid next year. And I know she's probably going to get between a 2 and 4%, on average a 3% increase in her pay. That's typically forecastable and foreseeable, unless she screws something up real big and the company doesn't want to give her a 3% raise for cost of living or inflation. So again, earnings we assume are static, they're forecastable, they're foreseeable, and they grow at an assumed rate. We're going to go ahead and skip this, but the reason we talk about this is because we're now going to kind of get into the world of the business owner and the investor, and to better understand how it is we sort of make money from money and how investing works. So again, when we understand price and earnings, imagine going to a bank to get a bank CD, certificate of deposit, and instead of walking in and saying, well, I have $10,000 and asking the bank, how much will you give me? Imagine instead the bank, you go into the bank and the bank says, look, we'll give you $10 a year. How much will you give us? And that's how most of the bond market and the stock markets work is you know what you're going to earn with it. Then you have to determine how much you will give or pay for that. In other words, the price. Now, when we do that, we can use a ratio or a number to figure out and contrast and compare all other types of investments. So if you were to go to the bank again and you give them $10,000 and they tell you how much they're going to give you, maybe it's 1% or something like that, that's how you analyze and compare bank CDs. Now, everywhere else in the world of investing in stocks, instead, we don't divide the earnings by the price. We divide the price by the earnings. And that is just the P&E ratio is the big number we look at. And that essentially is the reciprocal of the earnings yield. Okay, the earnings stay the same, but the price is what fluctuates. And in a nutshell, that's how we try to find good investments. Now, there's all types of analysis. A lot of times I get students that come in and they maybe have tried buying and selling stocks or things like that. And a lot of times they're looking at certain numbers and charts and trying to buy stocks based on that and to figure out what's good, what's not good. And they'll always ask me, Bruce, is this a good investment? A lot of times, though, what they're trying to do is what's called trading. They're trying to buy these stocks in short frequencies, and they'll do so by looking at charts to say, oh, well, this stock looks like it keeps going up. If I invest in it today, by 2 months from now, I should have twice as much because look at it. Well, let me get my arm here. Look at how this stock is climbing. Okay, so if I buy it right here, they think down here it should be worth even more. The problem with that thinking, and then they unfortunately start applying what's called buy low, sell high. That's not what's meant by buy low and sell high, and I'm going to teach you that in something called fundamental analysis. But before we get there, I want to talk about what's called technical analysis, and that's buying and selling things based on price fluctuations and the history of those price fluctuations. If we look at a comparable area where in the past a lot of students have understood, this would be comparable to flipping houses in real estate versus fundamentally buying maybe an apartment building to get income off it. That would be fundamental analysis or fundamental investing. Technical analysis is usually buying and selling assets and selling it in much shorter time frames or terms. Okay. So flipping houses would be a type of sort of technical analysis or technical investing. So in flipping real estate, you buy a house today, and because homes look like they're appreciating in that certain market and going up in price by leaps and bounds, you go in, you fix it up a little bit, and hopefully you sell it for many more times the amount of money than what you put into it. Okay. And that's similar to stock trading in the stock markets. We're not going to talk about that in here. We're going to talk about investing. Investing is usually thought of as long term. In other words, you're buying an asset and you're holding it for years and many years, at least 1 year. In that way, we also get a tax benefit because it turns into a capital gain. If we hold it for less than 1 year, that would be a short-term investment, and more, we're going to call that trading. So now maybe some of you have heard of something called Vector Vest, and if you go on CNBC and watch it for a while, there's all types of advertisements that talk about gimmicky ways of making money in the stock market, and get Vector Vest or some other trading platform that'll help you make all this money. Well, there's some truth about that. But first off, most of those don't work, and they surely don't work for a novice investor or retail investor. And I found this blog one day, and it just stuck with me when I was reading it, and that, I hope, is your perception on sort of gimmicky things that are sold on that stuff. And the blog post said, if I had a system for doing something, trying to make money quick, and it was guaranteed to make you $10 million a year, I would not be selling it for $99 on CNBC with free phone support for life. I would instead be sitting in front of a computer making $10 million a year. Okay? And that's what I want you to think of anytime somebody's trying to sell you something like that, gimmick to get rich quick. Well, if it was so cool, awesome, and worked so well, why did the person stop doing it and start selling it? And remember, if somebody actually found a surefire way to make money anywhere, you can almost be guaranteed they would not be selling a way to do that, because at the moment in time they sell it, then it usually makes it untrue that you can make all types of money on it. And that's kind of just the way markets work. So we have different types of analysis. We have technical analysis, which we're not going to talk about in here. We're going to talk about what's called fundamental analysis, and that pertains to investing and holding things for the long term, typically between 1 and 50 years. We aren't going to talk about trading. Now, one of the big benefits to holding on to these investments for the long term is, instead of being taxed at income tax rates, we instead get taxed at capital gains tax rates. Now, unless you make $300,000 to $500,000 a year or something way up there, the average tax rate or maximum tax capital gains tax rate is around 15%. Again, if you're making $300,000, $400,000, $500,000 a year, I believe the maximum capital gains rate is 20%, but you have to make a significant amount before you're going to be in that range. For most of us, it's about 15%. Now, one quick thing I want to talk about, I'll just give you an overview of what technical analysis is. Again, we're not going to go through it in any detail in here, but that's buying and selling assets in short time horizons, which is often considered very risky. And we have different types of trading. We have day trading or active trading, swing trading, and position trading. And each one of them have different amounts of time associated with them in which the stock is held. So for day active trading, usually you're holding stocks for a minute or hour, and then you cash out at the end of the day. Also, stock traders in New York, for example, are called traders, not investors. And then we have swing trading, and that's holding stocks for about 1 to 5 days, somewhere in there. And then we have position trading, and this is holding stocks for weeks or months. Again, we're not going to talk about any of that in here. Now, one of the things I want you to think of is any time if you were to buy and sell those stocks at high frequencies, delete that out here for a minute, and you maybe got a TD Ameritrade account and you're doing that because you think you're going to make money off it. What I want you to imagine is the person that's on the other side of that trade that is selling those shares of stock looks like this person and has all these computer screens and everything else in front of them, and that is the one selling it to you. And then ask yourself, who likely has better information on whether or not this stock is going to go up and down? This guy or you? And for most of us, we'd say probably this guy. The person that holds all the information is the one that'll probably win in that transaction. So I'm trying to kind of incentivize you to not do any buying and selling at high frequencies and doing that, because this is the person you're competing against. And I would hate to see you lose your money. All right. Okay, on to the next one. Now, if you are interested in trading, I would advise against it, but anyone can actually become a day trader if they have more than $25,000 and really good credit to get what's called a margin account. And a margin account is basically a loan for another $25,000 that you have to take part in certain stock transactions. If you are interested in doing something like that, I would advise you just get a job at a trading desk for a financial firm, and you can learn how to do it. Then we get into fundamental analysis. That's what we're going to talk about in here. Fundamental analysis is a technique that attempts to determine a security's value by focusing on underlying factors that affect the company's actual business and its future prospects. Some would say that you aren't really investing if you aren't performing what's called fundamental analysis. Now, fundamental analysis of a business involves analyzing factors of business related to potential investments. The determined growth rates of income and cash flows, we'll call that earnings, and applying risk levels to determine what's called the discount rate. Remember earlier on your midterm, we talked about present value, and present value equaled the discount rate. That's what we're talking about here. And then we apply it to what's called a valuation model. The foremost is the discounted cash flow model, which calculates the present value of future earnings through these various means. And we have different ratios that we monitor to see if what's potentially a good investment. Now we actually get into steps we're going to be using to learn to invest. And before we get into that, I want to make sure what page we're on in your guidebook. And we are on page 70 in your guidebook here. Now, you're probably going to want to have a paper and pencil ready when we start doing this, because I'm going to start assigning you the steps. This will begin your second project, and I will do another video that gets into the real technical parts, or not technical, but the more complex, in-depth parts to this. But again, you're going to want probably a paper and pencil so you can write down what you need to do, and by all means, go ahead and pause the video to go ahead and complete that. So the first step we need to do is monitoring the economy. And you guys have been doing that every Wednesday after 4 p.m. to see what the stock market's doing, or what the economy is doing. So we're concerned about this because we want to know what direction the economy is heading into, and we're asking ourselves, should we be investing money in the market right now? And is the market overvalued, or is it currently undervalued? The other thing we're looking at are what are the inputs we need for the valuation process, and what inputs are needed to input in the valuation models. Okay? So this is what we're trying to answer when we're monitoring the economy. I'm going to go ahead and shrink this up then, and I did this today. Give me one sec here. Whoops. I apologize. Okay, we'll go ahead and crank that up, and we'll switch this over. Okay, so again, this is that worksheet that you've been completing, you're monitoring to see what the economy is heading into. Now, the first three numbers don't mean anything in and of themselves, but you've been tracking it throughout the weeks here. So you could tell me based on that, are these indexes going up, or do they seem to be going in a downward trajectory, or are they kind of just staying there? And my guess is your answer would be, it's going up a little bit, but not by any huge leaps and bounds. Next thing we look at is the bond yield curve. And the bond yield curve should be going in an upward trajectory right now. So that means that it doesn't sound like we're going to be dropping the rate. The next thing, whoop, I forgot to put this in here, was the prime rate. Okay. Is that currently low or is it currently high? That tells us some other information. Maybe now is a good time to be borrowing money. The next pieces of information we need start getting into this thing called investing. And the first is, what's been the average P/E ratio of the S&P 500 throughout the last 70 years? And the answer is it's somewhere around 15.5. The next thing we look at is the forward P/E ratio of the S&P 500, and that's 17.94. Now, that's higher than this 15.5, which would suggest that right now the market is probably a little bit, or is expected to be a little bit overvalued. Okay. Now, if this number was less than 15.5, then we would think that the market is maybe undervalued. Now, even though 17.94 is more than 15.5, the average in about the last 5 years has been about 20. So knowing this, and I keep track of these numbers, I would say right now that's pretty cheap or pretty undervalued. And the next piece of information I need, and this is for the actual valuation process that we'll be completing later, is the 91-day T-bill and the 10-year T-note. Okay? So this is the information we need and we'll be using when we get into the rest of this. So I would say right now might be a pretty good time to invest, even though this is higher, but that's just basically because I know the average used to be 20. All right, again, this is what all those mean and why we're keeping track of it. So we're trying to figure out where we're at in the economy based on these numbers. And right now, I would say we are probably somewhere in here, okay? On a trend line, we are somewhere in here. Now, tomorrow we might slip into a recession for all we know, or we might continue heading an upward trajectory. We do know that, though, that we're probably not somewhere over here in a downward trajectory, again, based on that information. Okay, so we've talked about this, the average P/E. The next thing we need to do, okay, so I'm going to go back up here and show you what we just did. We just did step 1, we're monitoring the economy. Step 2 here, we need to find our risk tolerance or our risk appetite. So we're going to go to NJAES at Rutgers University, and I want all of you to go ahead right now and do this risk assessment. Now you can find this hyperlink if you go to D2L and you've downloaded this Excel master project portfolio student worksheet, updated it. I know I'm bad at making lofty titles here for something that's not that lofty. But you go in here, and this is where you did the benchmark. If you go into this hyperlinks tab, and you go down here, okay, you have the hyperlinks to go ahead and complete this. So if you click on Rutgers, you should have this investment risk tolerance quiz. Okay. Now, in the last couple classes, we've been okay to go ahead and take it online. But if too many people are trying to take it at the same time, what ends up happening is it freezes this up and it won't do this. If that's the case, you can go down here and actually, if you hit view results, you can download it, or use this scoring grid, and you can use a paper copy to complete this. So go ahead right now and go through and take this investment risk tolerance quiz. Go ahead and hit the pause on the video, and we'll talk about that when you get back. All right, so hopefully you completed this and you now have a score. What we're going to do then is we have to convert that score between a 1 and 10 score. So either up here, if you'd like, you can hit pause and quick do a conversion. So if you scored a 24, you would give yourself a conversion score of between 5 and 6, and write that information down and don't lose it. You can also, because we're going to keep moving on here, on page 71 in your guidebook is that conversion score. So I'll leave this here. You can hit pause right now if you want to quickly look to convert it. And 1 is the lowest risk and 10 is the highest risk. All right, once you have your conversion score, next we're going to look at something that's called an asset allocation, okay? And your risk tolerance, your risk assessment here is going to convert into an asset allocation. Now, an asset allocation is, let's say you have $1 million and you want to invest it all. Okay. The next step would be you don't want to put all your eggs in one basket. You want to put some of that money into maybe some stock here, maybe invest in some real estate, maybe invest in some other things like that. You don't want to have all your eggs in one basket. So what an asset allocation does is it tries to maximize your return by minimizing your risk by telling you how to split up each one of those stocks or into each one of those different types of assets or different types of stocks or what have you. It tells you how to go about doing that. Thereby, you reduce the level of risk, and yet you're still maximizing your return by putting your money into the right types of investments. Okay? So the next piece to this that we kind of need to remember is the different types of asset classes that we'll cover in this asset allocation are 1, large cap stocks, 2, mid cap, and 3, small cap stocks. Now, what we mean by large cap is earlier on we talked about shares outstanding and market capitalization in the definitions of the exercise at the beginning of this section. And you remember the term market capitalization. Well, that starts coming into here. And we have 3 sort of ways we classify the size of companies. The first is large capitalization or large market capitalization, or known to investors as large cap stocks. And large cap refers to companies that have a size of $10 billion and above. $10 billion and above. So if we multiply all the shares outstanding by the current share price that it's being traded for, and if it's more than 10 billion or 10 billion and above, we would call that a large cap company. Now, companies that are sort of in the middle there, we call those mid cap companies, and they have a market capitalization between 1 and $10 billion. Then we have small cap, which refers to companies that have a market capitalization of $1 billion and below. The next type of asset classes we have is foreign stocks. And foreign stocks are invested in foreign economies on foreign exchanges, and they're not usually assets or investments that are correlated to our economy. Okay? So when foreign stocks or maybe stocks in Germany go up, that doesn't mean our stock market's going to go down or up or anything else. In other words, they're not related. Then we have bonds. And bonds, we have corporate bonds, treasury bonds, all types of things like that. In this asset allocation, we're referring to corporate bonds, which, if you remember, is debt. Okay, a company's debt. And then we have municipal bonds. Governments, local governments, state governments, oftentimes to get money, will put out what's called a municipal bond. And municipal bonds usually, they don't pay a lot of interest, but they have a pretty good tax benefit because most of the time you don't pay any taxes on the dividends. And then our last section is cash in the market capitalization. We're talking about savings accounts, checking accounts that pay interest, money market, demand deposit accounts, and bank CDs. That's what we're talking about when we say cash. So now that we know your score, your risk tolerance, and I'm going to tell you my risk tolerance is about 7. Okay? So I think I score a 31 or a 30. So I'm going to put my risk tolerance as a 7. Now you'll notice up here there's high risk, and these numbers up here are split. Okay? So based on however you scored here, go ahead and just pick where you think you fall between 7 and 10. So as I said, I have a risk tolerance of probably 7. Okay. The next thing we're going to do is we're going to go back into that Excel spreadsheet, and we're going to open up the investment project tab. Go ahead and enter your name at the top, and we'll start filling this out. All right. In the second step here, and really that should be the first step, is your risk assessment. I'm going to go ahead and enter that converted score, which is 7. Okay. Now the next thing I need to do is I have to fill out all these cells here. Okay. So I need to go out and get an asset allocation. So I'm going to go back to hyperlinks. Give you a second there. And I'm going to go to this asset allocation calculator. I'm going to click on that. And this asset allocation calculator should come up. So we're going to start filling this out, and down here it will tell us the percentage of our money and where it should be going. So the first thing I need to enter up here is my age. I'll enter that in. The next thing I need to put in here is my current assets. Now, this is where you're just going to mentally enter a rough idea of what you think your total assets are or your total cash assets. You enter that in. And here we have savings per year. I would put this somewhere between 5% of your possible income. So set it to $2,000 just to make life easy on you for this. Next thing I need to do is enter my marginal income tax rate. And mine is that. Income required, this next section. I want you to leave this blank or leave it at 0. Okay, don't change this, don't move it. And the next thing I need to put is my risk tolerance. And again, that was a 7. That was that converted score from my risk assessment. The last thing we're going to put in is economic outlook. And that is for you to choose here. But I want you to choose it, based on your tracking of this. What do you think is going to be the growth, because you've been keeping track of this for the last few weeks, last number of weeks. Do you think the economy is going to be poor, moderate, or strong? In other words, are we going to expand by leaps and bounds? Or are we going to keep growing by about 3%? Or are we going to maybe go into a recession? I'm going to go ahead and leave it at 5, leave it at moderate. Again, that's for you to choose. All right. Once I have all those entered, I'm going to hit calculate. And I probably already did it. I'm going to just check something here. Okay, yep. Should calculate it automatically. All right. So what we're looking at here right now is you just got your asset allocation. So we're going to enter in all these percentages into that Excel spreadsheet. I'm going to write these down so I can just transfer them. Once you have this information, you can go ahead and take a moment, pause the video, and write them, or excuse me, enter them into the Excel spreadsheet. Okay, so once I've written down all these percentages, I'm going to go into that Excel spreadsheet. I'm going to go into the investment project, and I'm going to enter that in. So 25% for me, and these are going to change per person, so I don't want to see, for almost none of you, it won't be the same allocation as what I'm getting. All right. So now I have my asset allocation. Now we're going to multiply $1 million times your allocation, and what we get is the amount of money you will hypothetically get to invest for this project. So you'll have $250,000 to invest in large cap stock. Now we're going to move on to the next step. And the next step is we have to pick an investing strategy, and we'll pick this based on our risk assessment up here. Okay, so I had a score of 7, and when I go into this drop down box, I have 5 different options to, or investment strategies to pick. Now if you notice over here, depending on that, these numbers right here, 0 to 1, 2 to 3, 3 to 4, 4 to 9, and 8 to 10, correspond to this number right here, your risk assessment. So I have a score of 9, or excuse me, 7. So my strategy based on risk would be a value strategy. Now, if you have really low risk assessment, like 1, 2, 3, okay, still go ahead and pick it based on here. But for the purposes of this exercise, we're going to select either an income strategy, a value strategy, or growth strategy. You won't have a bond strategy or an ultra conservative strategy down here. So again, I'm value. I'm going to do that. So if you have a very low risk tolerance, like 1 or 2, you would pick, or 1 to 4 or something like that, you would pick an income strategy. I have a 7 up here, then my value strategy, and then I'm going to have a value strategy down here. All right, and that should get us to here. Now we'll quickly cover what each one of these strategies mean. We did our asset allocation. Now our risk tolerance kind of dictates or tells us what our investing strategy should be. And we're going to cover 5 different strategies in here. Okay? The ultra conservative strategy, the bond strategy, income strategy, value strategy, and growth strategy. And I have some fun pictures of each type of person that kind of relates to this. I don't even remember. This is Rod Stewart. Some of you may know his daughter from reality TV or something like that. But apparently Rod Stewart was a famous singer back 30 years ago, and sometimes yet today in certain parts of the world, but he is known as a penny pincher. He would have an ultra-conservative strategy, which is an investment strategy for those that absolutely cannot and do not want to lose their principal amount of money that they're investing. These folks should only invest in asset classes such as bank CDs and U.S. Treasury bonds. Typically, this would not adjust based on age, just risk tolerance. Then we have a bond strategy, and this is Mohammed El Rayan, he's actually a former CEO of PIMCO, which is the largest bond mutual fund in the world. Or it used to be anyway. Don't know what it is today, but he was always seen on CNBC. Now, a bond strategy is for typically a very passive investor, and it usually involves using bonds and bond mutual funds. Typically, bond funds are a little lower risk because they don't incorporate equity investments in them. There is still risk, though, because of the impact of prevailing interest rates that can have on the price of the bonds or the shares of a bond fund. Now, we're not going to talk about bond trading in here. We're going to be talking about bond investing, which is buying a bond and holding it until maturity. That's what we'll be talking about in here. And the type of assets that you would purchase if you're at a bond strategy are everything from U.S. Treasury bonds to municipal bonds to corporate bonds or bond mutual funds. The next type of strategy we have is the income strategy, and I can't help but think of my grandma when I think of the income strategy. And the income strategy is that's used when you need income derived from the investment, okay? My grandmother, if she invests her money, needs income every month or a periodic basis to actually live off of. So she can get that through bonds and other stocks that pay dividends. Typically, when you're retired, you're going to need income to live off of, and you don't want your money in business ventures where you're not getting income from it. Private equity firms sometimes will buy stocks and bonds in order to pay their payroll and pay for their periodic expenses. Okay. And then we have bonds. The investment strategy or assets that this person would want to buy is bonds and stocks that pay a portion of income or dividends and coupons payments. Then we have the value strategy, and the most famous value investor, is Warren Buffett. He's the most famous value investor ever. And these investors look for stocks that are undervalued relative to benchmarks in an asset class. In other words, they're looking for a good deal, a cheap stock. Now, studies have consistently found that value stocks outperform growth stocks in the market sometimes as a whole. Typically, companies that are small cap stocks have outperformed. Small cap value investing has been shown to outperform other types of investment strategies. And again, typically stocks and business ventures that are presumably cheap, and sometimes private equity investors get into that. Now, we're not going to talk much about what's called a GARP strategy, which is growth at a reasonable price. It's basically a combination of growth and value investing. So GARP, or growth at a reasonable price, is a combination of both value and growth investing, and it looks at companies that are somewhat undervalued and yet have a pretty good potential for growth. Warren Buffett actually suggested one time that growth and value investing are closely related. We'll go ahead and skip that. Then we have growth investors. This is the highest risk type of investing. And these are investors that look for investments that are expected to grow at faster rates, grow by leaps and bounds. In that case, sometimes valuations are irrelevant to this form of investing because nobody knows. If a company like Facebook, when it first came out, nobody knew how much that would grow by. Nobody had an idea. So if you're trying to run numbers based on nothing, then what you're producing is kind of nothing information. And that's why growth is so high risk, is because we don't know how much something would grow by. So the purpose of this class, we're going to assume that valuations are a part of growth investing. Now, Facebook would have been an example of a growth investment 10 years ago or 8 years ago when they first came out. And before they started trading on the public markets, Bono from U2 was actually an initial investor. And their purpose there is to invest, typically venture capitalists or people like Bono who invest in companies like that. Their hope is that once they go public and start selling the stock on an open exchange, the stock price will just skyrocket. So again, that's a growth type of investment. So again, here's our asset allocation. Here are the strategies that tell us when and how to invest. Okay, now the next piece of this that we need to cover before we actually go out and start doing this is for the 3 strategies that we're going to apply in, let me go backwards. All of us are going to apply a value strategy for the project. Okay? We're not going to do an income strategy or a growth strategy or GARP or any of that. We're all just going to do a value strategy so I don't have to explain this 12 times and have you guys get lost. Okay? But if you were to apply these strategies, you would try to seek out stocks. If you were looking for an income strategy, you would want to find stocks that pay a dividend between 2 and 6%. Okay? Anything over 6%, and a lot of students ask me, well, why wouldn't you want a stock that pays as high a dividend as you could get? Well, the problem with that is most investors think when a company is paying out too much like that, they're either really high risk or it's unsustainable. Most companies can't pay out that much money. And when the company does that, it's like they're trying to buy investors. Okay? So that's why it's often not thought of as a positive thing. And most people won't invest in an income stock-paying company if they're not getting more than 2% for a dividend, an annual dividend, or annual percentage on the dividend. For value strategy, we are going to try to find companies that have undervalued P/E ratios. So anything under 15 is what we're going to look for. And I'll go through that process and I'll take you step by step through what we're going to do. Anything over 15, we think that the company is potentially overvalued. Now, the next ratio we'd look at when we try to invest for growth companies would be a little different than P/E ratios. See, when a company is expected to grow by leaps and bounds, oftentimes its P/E ratio gets very, very high. It can get, I've seen them up to 100 something. And if we think anything over 15 is overvalued, okay, well then these growth stocks would clearly be overvalued when they have P/E ratios at 100. Well, oftentimes what this P/E ratio is not taken into account is growth. So what the PEG ratio does for these growth companies is it takes the P/E ratio and it divides it by the growth rate of the company. And when we do that, then we can get an accurate idea of whether or not the stock is possibly overvalued or undervalued. So anything 1 and under, we think it's probably appropriately valued or possibly undervalued. All right, we're not going to talk about ultra-conservative and bond strategies. For the most part, we covered those. Now we're going to get into understanding financial risk. And this is where we get into some ugly stuff, but we just need to understand it conceptually. The first is, how do we determine risk in finance? Now, risk is just applying statistics. It's we can measure risk through standard deviation of something, or standard deviation squared, which is variance, or we could look at covariance and compare a couple of different things, such as the covariance divided by variance of a stock by the S&P 500. We get what's called a beta coefficient, or simply beta. And what we're talking about when we see financial risk is how high and low sort of a stock price would be moving, or earnings would be moving. And that's how we measure risk in finance. If we have a tight distribution, ooh, I could hypnotize you like this. If we have a tight distribution, we would assume something has low risk. If we have this large fluctuation, we would assume something is high risk. And the reason that is because if we try to forecast in the future and we have a wide fluctuation, well, that means we don't, it could be anything from here down here, we don't know. But if we have a tight fluctuation like this, well, then the range in which we forecast is only like this. So risk is a higher fluctuation of sort of the past to determine, so when we forecast, we can try to figure out the unknown, which is the future. So, and we do that with stocks with something called the beta or beta coefficient. And how we measure the beta coefficient is, I'll start with a beta of 1. A beta of 1 suggests the stock has the same risk as the market overall as a whole. Okay, a beta equaling 1. Now, a beta less than 1 would suggest that the stock is less risky than the market as a whole. And a beta greater than 1 suggests the stock is riskier than the market as a whole. So we'd probably say a beta greater than 1 is riskier. Beta of 1 is the same risk. A beta of less than 1 is less risky than the market overall. And a negative beta coefficient is kind of interesting, because what that means is a stock that has a negative beta means if the market's going up, this stock price of this would be going down. Here, yeah, we'll go down like that. And they go in other words, they move in opposite directions. So if you have a perfect negative beta of -1, that means when the stock market goes up, the stock price goes down of this stock. When the stock market goes down, the price of this stock goes up. So it's kind of interesting. And what those stocks can be used for is a hedge when setting up an investing portfolio. All right. And that's what we're talking about here with those fluctuations. We're done with this video. The next video, like I said, make sure you have some paper and pencil, and you're going to have to print off some documents. Before I stop the video, what I'd like you to do now is go ahead and go into D2L, and I would recommend you print off this new fall 2014 valuation worksheet. Print off 3 of these worksheets, and I would download them so you can print them off. Wait for that to come up. I'm going to go ahead, hit Control Print, and pages, we're going to do 3. Oh, whoops. We'll leave it at all. We're going to do 3 copies. I'm not going to do that because I've already done it. So again, you're going to need 3 copies of this new FA 2014 valuation worksheet that's found in projects and other info on D2L. 3 of them. All right. And that's it. The next time we will do the next video on investing will be stock valuations.